Okay, everybody, it's Aaron Fragnito here with People's Capital Group. Hopefully you can hear me well and see me well. The internet connection is being a little funky today, so hopefully you don't lose me halfway through here. If anything happens, if the internet slows down, if my voice stops or the video slows down, just stay on. It'll come back. Sometimes it lags a little bit. Hopefully we don't run into that tonight. But if there's any technical difficulties and my internet lets out, just join back into the webinar and my internet will pick right back up and I'll jump right back in and I'll start right back up again. So hopefully that's not the case, but it's been a little funky the last couple of days. We're getting that looked at. So hopefully the internet stays strong this entire time. We can have a good webinar about how to self-direct your IRA into real estate. We are live on our Facebook group here. I see a chat here. Yes, asking for a recording. So yes, we are going to send out a recording of this webinar to anyone who signed up for it. So hopefully you can stick around for the whole webinar, but we will send out a recording. And also, if you have any questions as we go along, put them in the chat or put them in the Q&A. And I'm going to answer all questions at the end. And if there's any technical difficulties and we're kicked off again, just jump right back on. I'll start it right back up again. Hopefully that's not the case. Quick disclaimer, this is not solicitation for funds. This is not legal advice, tax advice. We're going to talk about tonight is how to self-direct your IRA into real estate. Maybe you have a solo 401k that you're looking to self-direct as well, and move some of your IRA or some of your solo 401k into real estate where you don't have to do the work to manage it day in and day out or look at a bunch of bad deals to find a good one. That's what Seth Martinez and I do to run People's Capital Group and service our investor group. And that's what we'll talk about tonight. How to take your IRA or your solo 401k, work with an IRA custodian, and then self-direct that into a real estate syndicate, which is People's Capital Group. And that's me, Aaron Fragnito. I'm one of the owners of People's Capital Group. And our mission tonight is to transform personal finances and quality of life by creating passive income streams through real estate. That's our mission in general, People's Capital Group. We've worked with investors for about 10 years now in New Jersey, buying properties. Our investors are all over the nation, mostly New Jersey and New York, but we focus on buying real estate in New Jersey. We have an in-house management company, and we really try to help people create passive income through real estate by investing with us, but true passive income. None of this stuff we have to manage a management company or deal with the phone ringing. And it's really important to understand the value of true passive income. We'll touch on that a little bit tonight. And I read a book called Rich Dad Poor Dad years ago, and that's how I got into real estate investing. That's why I decided to commit myself to creating passive income and build a portfolio of real estate, income producing real estate. And Rich Dad Poor Dad say the moment you make passive income and portfolio income a part of your life will change. So truly is a miraculous thing when you're creating financial freedom for people and for ourselves. It's an amazing feeling. So a quick note here on People's Capital Group we established in 2013. Seth Martinez runs the operations side of the business. He manages the management company. We're located out of Berkeley Heights, New Jersey. We have a staff under us to help us manage our portfolio of about 116 units right now, about 17 million in holdings. So we're buying and selling apartment buildings. We've fixed and flipped over 50 properties. We've wholesaled over 100 properties. We've done over 250 real estate transactions together. And we've built up a nice real estate portfolio, a nice group of about 50 plus investors that reinvest over time in our apartment building opportunities in New Jersey. And about a third of those people self-direct their IRA or solo 401k into real estate. So we're very familiar with that process. We're very friendly with it. And we'll talk about exactly how that's done and how they work that into our real estate syndicate this evening. Our agenda is number one, why do people invest in New Jersey apartment buildings? We'll talk about why we focus on this market, what we like about it. Number two, why do people prefer a syndicated investment? That's where people are going to pool their capital together. That allows individuals to get invested into a larger building with a smaller investment amount. That way they can diversify part of their IRA or solo 401k into a property in a high demand market. Number three, why do people value PCG's service? So we've created a nice turnkey service here where people can get qualified and get invested passively in buildings without doing all the work behind the scenes to make the real estate investment work and make it profitable and successful. So let's touch on Corona here. I won't spend too much time on this slide. The market has changed over the last 18 months. We're no longer flipping single family homes. There's a place and time to do that. It's too hard right now. The market's too tight for it. Although the sale of real estate is very profitable right now, but finding a good fixer-upper and the profit is not there right now. We really focus on apartment buildings. They're more tried and true. You always need a roof over your head. Class C and Class B apartment buildings, so mid-level to one level up from that apartment buildings is what we focus on. And we focus on finding mismanaged apartment buildings in North Jersey and repositioning them with our management company. That means improving them, creating better value, better cash flow for our investors. And that's really our specialty. We are looking to self-storage, but we don't have any of that right now. Office and industrial, we're not bullish on. Retail, we're not bullish on either. The pandemic and online shopping has really hit both of these fronts. Hospitality and senior housing, we like that space. We do have some short-term rentals, some Airbnb properties. That's good, but that's not our bread and butter. The majority of our holdings, the majority of the wealth we build for our investor group is through apartment buildings. So when investing through a pandemic here, or just through any type of market, you want to be aware of the market, where we are in it, but also recognizing the long-term view. People say, well, is it a good time to buy? Well, it is a seller's phase too. So there was perhaps a time you got cheaper real estate, more real estate for your dollar, that's for sure. But if you know how to buy real estate, if you know what the strategy is long-term, you can always find value in real estate. It's really hard to find a good deal right now. The one we have is phenomenal and it's getting funded very quickly. But when we do find a good deal, it's a nice opportunity for people to put their capital quickly to work into real estate. The first step, however, before investing in real estate is educate yourself. Make sure you understand what you're investing in, how the reposition is done, what the strategy is to build value into the property and create better returns to the investor. Is the plan to sell the building or refinance it? Also work with experienced professionals, right? The bottom line is you can make money in a lot of different markets in real estate, a lot of different types of real estate. But if the individuals operating the LLC, operating the business, operating the project don't know what they're doing, don't have a good track record, haven't been through the market enough, cycled a few deals, made their mistakes, right? Built their relationships with the good contractors and the good people we want to work with, the good management systems, then maybe they're not a great investment just yet. You want to make sure you're working with experienced professionals that know what they're doing and have been investing in a market for some time, working with other people's money. So things to take into consideration, the history of the market, right? We focus on North Jersey because we work off that New York City market. It's a consistent demand, consistent growth in this market, lots of Fortune 500 companies. Also degree of risk, right? We like existing real estate, not ground up real estate necessarily, although we do look at that sometimes, but for the most part, we like existing mismanaged apartment buildings that we can come in with our management company and improve the management of the building. By the way, I see more people are jumping on here as we go, which is great to see. We do this webinar about 6 times a year, so I'm glad you could jump on and check out how to self-direct your IRA into real estate. If you have questions, put them in the Q&A or the chat. As we go, I'm going to answer all those questions at the end of the presentation. It'll be about a half-hour, 45-minute presentation tonight. So a location as well, right? We talked about location. We like buying near train stations, near schools. We're buying a 27-unit, 2 blocks to a train station right now that gets you into Manhattan in 45 minutes. That's a good, consistent situation where you're going to have consistent demand. That's a good infrastructure in a nice city, Rahway, New Jersey, with a nice downtown market. So you want to look for those situations where you're going to be in your train stations, in high demand markets, near large cities with tons of jobs, good long-term, high-paying jobs, right? You want to, not all jobs are created equal, so you want to recognize that, and that's why we like North Jersey. Wages continue to rise, rents continue to rise. We have a highly skilled workforce. We rank number 1 in education, number 3 in median household income. 20 Fortune 500 companies are here. Number 1 in drugs and pharmaceuticals. Number 2 in direct foreign investments. So we're very bullish on New Jersey, North Jersey in particular. And that's where we have our infrastructure, our management company. And that allows us to manage these mismanaged properties better when we buy them and take them over and produce them, get them producing cash flow for our investor group. So this is all important to understand why people are self-directing their IRA out of the stock market and into real estate, right? Why would someone do that perceived risk? Well, this is why, because we're experienced professionals that are finding these opportunities, and with the infrastructure in place, we improve the management of them. it's pretty easy to understand then how we can improve the income on the property. We'll kind of dig into that a little more tonight. So our investors are seeking legal tax shelters, more predictable investment returns to fund more important occasions in life. So often being in an index fund that rides the stock market is not a very desirable place to have your entire nest egg. In fact, it never made sense to me why most financial advisors tell you to keep your entire IRA or solo 401k in an index fund. I understand that index funds have done well, but you want to really diversify. You want to have some of your investment truly in cash flowing, well-managed real estate that's in high demand markets, just maybe a third of it or some of your IRA into that type of asset class, in my opinion. So that's what our investors are seeking, are low risk investments. We're buying larger properties. That means vacancies hinder us less, repairs hinder us less. See, if you have a boiler that breaks on a 2-family and it's $5,000 to fix it, well, that might be your entire profit for that year. Where if your boiler breaks on a 30-unit property, well, that's going to be just a drop in the bucket compared to your rent roll on the property. So vacancies and repairs hinder you less. Having more units under one roof is a safer investment, but then you need a large amount of capital put down. So by pooling capital together, investors can get into larger properties that are safer investments by not investing the full amount, though, of course, and investing in a syndicate such as ours. So people are looking to invest in ideal New Jersey properties with easy access to New York City. And that's what we're seeing right now, right? A lot of people don't have to be in New York City 5 times a week now. They can be in their job in Manhattan maybe twice a week. So living in North Jersey makes a lot more sense. And that's one of the reasons we're seeing our values just skyrocket in the North Jersey market and rental prices as well. So well-managed New Jersey apartment buildings tend to fare well in recession. They're more predictable cash flowing assets than the stock market. And we feel that the tax depreciation as well helps investors lower their tax burden. Of course, with a 401k and an IRA, the tax depreciation is a bit of a wash through, so we won't harp on that too much, but that does allow you to avoid anything like UBIT on an unsecured business interest tax, which your IRA custodian will explain more to you about. The bottom line is it's a tax advantaged account, and real estate offers additional tax advantages as well, even if you're not investing through an IRA or solo 401k, which about a third of our investors are IRA investors. And so our group of investors enjoy funding important occasions in life with their investments, having a completely passive scenario, passive experience where they're reading monthly updates, enjoying quarterly cash flow checks, quarterly financials, enjoying K-1 tax returns, and not having to do the work day in and day out. The tax prep as well. We work with a whole third-party bookkeeping tax firm that does all of our tax prep, so tax time is very easy for our investors. And as I was saying earlier, larger buildings make more sense and they're safer investments than smaller buildings. So by pooling capital together, Seth and I are able to pool together the down payment and repair estimate for a property. And that allows us to then, Seth and I, go get the mortgage. We'll leverage that investment from our investors. Seth and I will personally guarantee the mortgage if we have to make sure we get a great rate and have low closing costs. And that's another thing we do to take the risk off the investor. Right? So if you've bought a home and you got a mortgage, you probably personally guarantee that mortgage. And that's a big risk. That means you owe that debt through foreclosure, through bankruptcy. So personally guaranteeing debt means you're in it to win it. And we are truly committed to these investments by doing that. And that also makes sure we get great terms on the mortgage as well, and allows our investors to avoid that additional risk there. So by focusing on that North Jersey market, we hold consistent demand. We focus on running into millennials and families and making family-friendly environments of mismanaged properties, make them into nicely managed properties where people feel proud to live and they don't mind paying more in rent to live there. And we also aim to attract a higher end tenant. We focus on Newark, Passaic, Patterson, Jersey City, Plainfield, Rahway, Union County, Essex County, Passaic and Hudson County. And we focus on buying those mismanaged properties. Really, they don't have to be in terrible shape. We just want mismanaged properties that have low rent rolls and room to improve the rent roll. Right now, we're buying a 27-unit. Rents are 30% below market value, 2 blocks of the train station in Rahway, New Jersey. That's a recipe for success, and that's what we look for. Okay, so number two, why do people prefer syndicated investing? So first of all, you don't want to manage the property. Property management is really not a fun job. It's a thankless job. It's very detail oriented. It's taken us years to develop a very good property management company, and we finally have. And they're focused on the art of repositioning apartment buildings, renegotiating leases, finding out ways to lower our expenses, figuring out cash for keys with certain tenants, managing construction and renovation of properties and units throughout, inside and out, common area, roofs, apartments, kitchenettes. All these things need to be done on our current property we're buying, and these all need to be done, managed and overseen by Seth and our management company. Lots of moving pieces to this. It's not a passive investment if you're the operator, for sure. But that allows us to build the value into the property. We've been doing this for years. We have a good team in place. And by pulling the capital together, we limit the risk as well for our investors. And our investors really enjoy the idea of tapping into expert real estate knowledge, being lifted up above those pitfalls, getting into off-market deals, and having their free time, not have to deal with being a landlord. It's extremely important. Your time is everything. So once we buy the property, we'll force equity into it by a number of avenues, finding more ways to make income on the property, parking, storage, laundry, finding out the best way to get top dollar for each unit by either working with the tenant, being very professional, making sure all their needs are met, fixing that leaky dishwasher, doing the items that we were probably going to need to do anyway, and then renegotiating the lease up to the top dollar, or working out of cash for keys, doing a full renovation of the unit, and then renting it out to a new tenant for top dollar. So we're going to work both of those strategies with the units, depending on the tenant, depending on the situation, depending on their goals and ours. And this allows us to get a higher rent roll for the property, lower our expenses, get more net income on the property for our investors, more cash flow. And as we increase that cash flow, we increase the value of the property. See, the more cash flow a building makes, the more it's worth. And then we do a refinance over a 3 to 5 year period where our investors have certain exit options to get back their initial investment, keep the funds from the refinance, keep the funds from cash flow, or choose to stay invested, as about 9 out of 10 of our investors choose to do, and remain in the investment, continue to get the cash flow, continue to get a large sum upon the refinance every 4 years or so. And of course, so we have a long-term view of real estate. That's what also separates us from other syndicates. First of all, we have in-house management. Secondly, we have a long-term view of real estate investing. Seth and I love real estate. We plan on handing it down to our kids one day. It's legacy wealth for us. We've invested in good markets. We've developed a good system. We have a good investment group, and real estate's a tried and true asset class. Our buildings are worth 2 or 3 times what we paid for them. For some of the buildings we bought 8 years ago, 10 years ago. So we'd be fools to exit that market where we can do so well with it over time. So we'll invest up to $10,000 a month to find great opportunities for our investors. We'll look at over 400 properties to bring one well-vetted opportunity. We'll go through many levels of due diligence to make sure it's a smart, safe investment and meets our strategy. And we have over 10,000 people in our network. Maybe that's investors or wholesalers or brokers or contractors or just executives or people that are busy and professionals looking to invest in real estate. And have found us on Meetup. We have nearly 4,000 members in our Meetup groups, New Jersey Real Estate Network. We also have been doing networking events for about 10 years throughout New Jersey, and many seminars, and we have many people on our list and our network and our group, and we're going to start opening up to having in-person events next year as well. So we're looking forward to that and getting back into that. So we've secured funding on over 250 properties, over $40 million, and right now we have about 17 million or so in assets, about 116 units. So we focus on getting good terms on our mortgage as well, making sure that we have well-structured deals where it makes a lot of sense for our investors. And we also do a situation where we're very limited on our fees. We really focus on just creating a nice equity situation for our investors where everyone does well in the investment when the investment does well. So it's really a win-win situation for everyone. It's not a fee-based structure either. So why do people value PCG's service here? So we're aggressive calculating business model. We've made it easy for people to self-direct their IRA into real estate. That means you can select an IRA custodian, work with that custodian who's can then contact wherever your IRA is and help you move that IRA to the custodian and then into a real estate investment opportunity. We help people do that. We help guide them to perhaps the right custodian for their goals. We even have people that we can put you in touch with that can help you select the right custodian. And we've worked with a number of them as well. So I can tell you some of the differences of them. For the most part, they all do the same thing. There are slight differences in fees and how fast it takes them to do it as well. So if you're interested in finding the right IRA custodian, you can email us at info@peoplescapitalgroup.com or just reply to our emails. And we can put you in touch with someone who helps people select the right IRA custodian. So here's how we find the deals, though. Here's how we structure, here's how the system works. So we do lots of marketing to find the right opportunity, sometimes $10,000 a month. As I said, we look at sometimes up to 400 properties to find the right one. We look for value add. That means places we can improve value on the property, rents are below market value, the property needs some renovation, but it's in a good area and it's got a lot of good potential, good bones. So we'll pull together capital to buy the property. Investors will own a part of the LLC created by the property. There'll be non-voting members, passive owners of that property. If they're investing through an IRA custodian, their IRA custodian will own that share of the LLC, and the cash flow checks will go back to the IRA custodian, and same with the lump sum upon the refinance and so on. Once we buy the property, we manage it for income streams, passive income streams to our investors. We plan on doing that refinance where the investors have the exit option, which we'll break into a little bit more in a few slides. So we increase the net cash flow of the property. That increases the property value, right? So real estate, commercial real estate is valued like business, like a business. So the more it makes, the more net cash flow produces, NOI, net operating income, the more it's worth. The more it's worth, the more equity we have. That's the difference between what the property is worth minus your debt. That allows us to create more cash from the refinance. So we go to refinance the property. We're going to get a larger loan amount. It's a safe amount of debt at a low interest rate. The bank wouldn't allow us to get more debt than the property can handle. But now the property is worth a lot more money because it earns a lot more money, and the property values have ideally gone up as well over time. Although we're not relying on that all that much. It's a very conservative estimate on that front. But we then go to refinance the property over about a 4-year period, and that allows us to split up a lump sum amongst the investors. Now, this situation here is, even if you're not invested through an IRA or solo 401k, it's still a tax-free situation if you don't exit the investment. Since we plan on eventually doing a 1031 tax deference and trading up into a bigger building, we plan on deferring those taxes indefinitely. So most of our investors stick with us through the refinance. And first of all, we produce better returns generally than targeted. Historically, we hit about 10 to 15% better than targeted. So investors say, hey, these guys under promise and over deliver. I'm going to stick with them. Secondly, as the property gets going, the more longer we own it, the better of an asset it is, the more cash flows. And thirdly, if you don't exit, you don't pay taxes, right? So you don't want to pay taxes. You want to keep your money, not give it to the government. So the better strategy is to stay invested long term, and that allows our investors to earn a better ROI, keep more of their money, and boost that internal rate of return up into the mid-teens or higher, depending on what the markets do over time as well. So here we focus on creating that passive income stream. We manage the properties with the exit strategy in mind as well. Of course, you don't have to exit, but investors have that exit option. So we have a long-term option, which investors enjoy. We have the exit option as well. And we have an aggressive, successful repositioning track record. We really just focus on repositioning New Jersey apartment buildings. We don't sell coaching or education. We don't flip houses anymore. Sometimes we'll flip some land or things like that. But for the most part, we really just focus on acquiring mismanaged apartment buildings, buying them with our investor group, who about a third of them self-direct their IRA or solo 401k. Having low vacancy rates, high collection rates, right? We have our in-house property management. This allows for exceptional tenant care. And that allows also for calculated construction costs, staying on budget with the project. We only manage our own properties. We're laser focused on that. So this will allow for consistent cash flow from our assets to our investors. And it's really important to understand how important property management is. It's so important that we've worked with numerous property management companies before, and we just felt they weren't nearly as good or doing what we need them to do to take a mismanaged property and make it into a performing asset. It's a lot of work. It's more than just calling a plumber when the pipe leaks and collecting the rent when it's due. There's a lot more to it when you're repositioning a mismanaged apartment building. So we developed our own management company, and it's been one of the hardest things we've done, but it's been one of the best things we've done. And it's allowed us to give a complete competitive edge to our investor group. And that's been very good for us for many years. So here's the exit options. You can stay invested at the refinance. We plan to refinance every 3 to 5 years. This next opportunity we're buying is about a 4-year finance period. So you can stay invested, continue earning cash flow, keep the funds from the refinance, monthly updates, quarterly cash flow checks, quarterly financials, annual tax returns. We'll refinance again year 4, probably around year 8, and again around year 12. And then we plan on doing 1031 tax deference. We exhaust the tax depreciation maybe around year 15. It's hard to say at this point, but we have a very long-term strategy there. Or you could sell, get back your initial investment, keep the funds from the refinance, keep the funds from the cash flow. But of course, there could be tax consequences there. But if you do an IRA or 401k, you're going to defer those taxes. You're going to be tax advantaged. So your IRA custodian will talk to you more about that. But of course, like any investment with your IRA, you would not be taxed on that growth as long as you follow the rules of the IRA. So to date, we've pulled over about $7.5 million. Over $4 million of that has been returned to investors. 9 out of 10 of our investors reinvest over time. Minimum investment is $30,000. We work with non-accredited and accredited investors. So we work with sophisticated investors. That means they understand the investment opportunity. They have about twice the minimum investment amount, so they don't need to live on the returns of the investment. And they have ample income as well, and some investment experience, perhaps in real estate also. That's a sophisticated investor. So that's the one that's non-accredited. Now, most investment groups don't work with sophisticated investors. We do. Most investment groups only work with accredited investors, and those are millionaires. Those are people with a net worth of $1 million, not including their primary residence, or an income of $250,000 individually or $300,000 with their spouse. So that an accredited investor is a millionaire. Most real estate syndications only work with accredited investors. We work with accredited and non-accredited or sophisticated investors. So if you're not sure if you qualify to invest with us, but this might be a fit for you, you can go to our website, peoplescapitalgroup.com, and fill out the application form, and we'll get back to you and let you know if you do qualify. Here's a couple quick case studies here. We're going to just kind of break this out and how we work with investors and how we structure these acquisitions and what it looks like for the investor and what their experience would be like. So here's a 5-unit property in Newark. Now, this is a small building, but this is a great example of something we bought years ago, and it's just done very well for ourselves and our investors. We bought it for $110,000. It was a 5-unit outside of Rutgers University in Newark. So, boy, oh boy, wish I could get that for that price now. So we captured. They were asking $130 at the time. It was the fixer upper. We captured $20,000 in equity right off the bat. We put about $30,000 into the property, and not a whole lot of renovation there. And that's really the trick, right? You don't want to break the bank on the renovation if you don't have to. You want to make sure you give the tenant a right quality of life, good quality of life, a nice place to live, good place to raise their family. You want to respect the wishes of the tenant, make sure that a happy tenant equals a happy investor. So we take care of our tenant first, come in very professional, their best foot forward. But that doesn't mean we're going to break the bank renovating the property. We're just going to do what's necessary to get the property up to code, make it a nice livable unit as well. And depending on the building where it's located, we'll do different levels of finishings as well. So in this case, the value of the property 1 year later was $310,000. So we bought it for $110,000. We put $30,000 into it. 1 year later, it appraised for $310,000. So we were able to pull out our entire initial investment. Our investor made his initial investment back in 1 year. Of course, our larger properties don't move that quickly, but just a good example of how buying a building for the right price, renovating it for the keeping your costs low, and buying in the right area. Also, the value boosted over time as well. So we refinanced there, and that allowed our investor to go to a 20-80 split with us owning 80, investor owning 20. Usually it's with the investor owning the majority ownership. This is a little different split in this case. And then we refinanced again in 2017, split up another large lump sum of capital, and the property continues to cash flow. Not a whole lot, but we cover our costs. We get a little bit of cash flow quarterly or annually, and allows for tax depreciation as well, so we can write off all that cash flow. Of course, an IRA would be tax advantage regardless. Here's a 25 unit we bought in 2014 and sold 2.5 years later for a nice profit. It's in Paulsboro, New Jersey, and they were asking $1.2 million. We paid $1,075,000 for it. So right off the bat, we captured $125,000 in equity. That's our job, is to get a good price on the property, make sure we're not overpaying for it. In fact, the building we're buying right now appraised for $3 million. Current condition. We're buying it for 2.75. You always want to make your money when you buy in real estate. So here we secured a bank loan for 75% of the purchase price at a 4.5% interest rate. That was 2014. I remember people saying that interest rates were going to go up, so you better buy property. Interest rates are now, we're getting them in the low threes. Incredible cost of money right now. Money is very cheap. Rent is very high. It's a great time to own real estate because debt is used as a tool to own real estate, and debt is very cheap right now. Money is very cheap. So we had 4 private investors come in at $100,000 each. And we did a 60-40 split on this, with the investors owning 60, us owning 40. We sold the property about 2.5 years later for $1.35 million. Our investors earned about a 26% profit. They earned about a 10.5 to 11% cash on cash return on their investment when annualized. So we had a nice return there for our investors, and we did better than targeted on both those investments. And we generally do about 10% better than targeted because we're very conservative in our numbers. We assume the market stops growing. The market's been growing. We assume that doesn't keep happening, and a number of other conservative assumptions as well that we actually do better in real life, like collections and lease loss and things like that. But we assume we're not going to do that good in the scenario of buying the property. So we underpromise and overdeliver to our investors. We continue to do that. And that's why people continue to invest with us. Okay, let's talk about the IRA portion of the offering of the presentation here tonight. So we're talking about self-directing your IRA or solo 401k into real estate. So the first thing you need to do is find an IRA custodian. You have to select an IRA custodian to be able to do this. You cannot self-direct your IRA without one, or your solo 401k. There's over 50 IRA custodians that I'm aware of. So you'll want to do your shopping around, and we could put you in touch with someone named Alan Johnson. Now, what he has is a software that allows you to put in what you're looking to do with your IRA, and it'll give you like the 3 best options through us IRA custodians for you. I think it's about $15. It might be worth it. I think it is. If you're looking to do something serious with your IRA and self-direct it, it could save you hundreds or thousands of dollars in the long run, possibly. So first thing to do is select that IRA custodian. And it's really not very much to self-direct your IRA. Generally, it's about $50 to $300 to start an account and move the capital into your IRA custodian. They're going to take care of most of the process. They're going to tell you, what to do. They're going to give you the forms. They're going to contact your current IRA holder. Let's say it's Fidelity. They're going to contact Fidelity. They're going to, say, okay, John Doe asked, to self-direct $100,000 of his IRA from Fidelity over to Next Generation Trust. And now they're going to be moving that IRA over, or Alto IRA, or whoever you select to be your IRA custodian. And then your IRA custodian will hold those funds. And at that point, depending on who you've selected, the IRA custodian will either want to review the operating agreement, the LLC formation documents, the offering memorandum, all the documents that we supply as the operator when you're investing in an asset with us. And so the IRA custodian will probably want to review that. Some actually don't review it. Others do. They all kind of have different fiduciary responsibilities, right? So understand who you're hiring. Do you want a company that's going to review all this stuff and make sure it's IRA friendly, or do you not want that company? Maybe you don't want that blockade possibly, right? Or maybe you do want that added security. Either way, our documents are always IRA friendly, and they've been reviewed by many IRA custodians, but there's advantages to working with both. I know Alto IRA, you can basically just sign up, start your account. It's all done online, and then they don't even look over the documents that you're investing into. It's really up to you, right? You'll sign documents and say, I understand, it's up to me to do that, right? So it depends what you're looking to do. So you'll decide the right IRA custodian for your goals and your comfort level. And then quite simply, they're gonna help you move the capital over to the IRA custodian, however much you select to do when you fill out the paperwork. And then they're going to move it into the investment opportunity you've selected. Now, there's rules and regulations on what you can and cannot invest in, right? You cannot take your spouse out to dinner. You can't put your kid through college. You cannot buy a vacation property and take your family there on the holidays for free. So there are, you can invest in your brother's idea for that tech company. You cannot invest in your son's idea for that tech company, or your father's, right? So you have to understand you can not go vertical on the family chain. You can only go horizontal. So there's different rules and regulations, and your IRA custodian is going to guide you in this process. But again, other IRA custodians may not review the documents that you've selected to invest in. So just know who you're working with, know who you selected to be your IRA custodian for what purpose. So once you have the approval to then invest in that asset, the IRA custodian will simply wire the funds to the wire instructions given by the operator. In our case, we have the title company hold the funds prior to closing. So if for whatever reason the deal doesn't close, title's bad, something like that, the funds are returned very quickly in full. We don't even deduct the wire fees. We take care of that ourselves. So we make sure that if for whatever reason the deal isn't closed, the investors get back their money, of course, right away. The title companies holds those funds prior to closing. That's just one more added level of security. But you want to understand when you're investing in real estate syndicate, who holds the money before closing, right? That's a pretty important thing. And what happens if it doesn't close, right? That's a good question to ask. So then we go ahead and close on the real estate, of course, that's the plan. And then we go ahead and create positive cash flow from the real estate. Those positive cash flow checks are going to go back to your IRA custodian. And you'll have a login. You'll be able to log in, see how your IRA account's doing, right? Just like any type of investment company, ideally. Hopefully they have that. If they don't have a way for you to log in and check your account, they're probably not the right IRA custodian for you, I'd imagine. So it's very important to keep track of that. For the most part, your IRA custodian is going to be getting those checks and depositing into your IRA custodian account. You will want to check that at least annually to make sure they're like putting the checks in the right account. I have run into situations where they were like putting them in the wrong IRA account or something like that, just like the person had 2 different IRA accounts. So you just want to be aware of that. And then for the most part, the quarterly financials are going to be sent to you, the individual, not the IRA custodian. And they're not really too concerned about the quarterly financials. The monthly updates are sent to you, the individual, not the IRA custodian. But the tax forms, that would be sent to both. The IRA custodian would get the hard copy of it. You would get an electric copy of it, the K1 tax form at the end of the year. Because the K1 tax form is made out to the IRA custodian's EIN. Just a little detail there, not hugely important, but that's how it works. Now, you can do something called a checkbook IRA LLC account. Now, you don't need to do this. I'm going to touch on this because it's important to understand. I think it should be part of the presentation, but this is an unnecessary additional step. The only reason you would need to create a checkbook IRA LLC account, an LLC that's owned by your IRA, but managed by you. Okay, so again, that's an IRA that's owned by your, it's an LLC, sorry, that's owned by your IRA, but managed by you. Now, you can't take a management fee. You can't take the money out early. You haven't cracked the code to pull from your IRA without getting fined. It's not what this is. This is a situation, let's say you want to flip a house, okay, and you want to invest with People's Capital Group. Well, that house you're flipping, you're going to need those checks very readily. You're going to need to pay the contractors and the plumber, and they don't want to wait for their money. So you need to be able to get those checks right away to them. Your IRA custodian might charge you to release a check. They might take 5 business days. I don't know the last time was you told your contractor they're going to get paid in 5 to 7 business days, but then the next time you call them, they'll tell you I'll be there in 5 to 7 business days. So you want to pay your contractors fast to get fast service in return. So to do that, you'll need to ideally create an IRA LLC checkbook account. This is an LLC that's owned by your IRA and managed by you, but this is a regular then LLC operating account that you can access quickly. You can write a check right there to the contractor. Boom. You don't have to contact your IRA custodian, send them the information. They have to process it. That takes a few days, and the check goes in the mail. You know, they put the wrong name on it, whatever it is. So you always want to try to avoid that. If you need access to the money very quickly, right? Maybe you're investing in a company or some type of project that you need access to the money very quickly and readily. Now, if you're investing in a syndicate, a real estate syndicate, you really don't need access to the money very quickly. You need to access it once to move it into the investment opportunity. And that's really it. I mean, if you want to exit the investment, you're going to notify us, 120 days in advance from the refinance, but that's years down the road. So really you're focused on just moving the capital once into the investment, and then we will send back cash flow checks and a large lump sum upon the refinance to your IRA custodian. So really, you don't need the checkbook IRA LLC account if you're just investing in a syndicate. If you feel like you're going to need the money very readily, very quickly, then you're going to need to take that extra step, start an LLC that's owned by your IRA, managed by you, We actually have an operating agreement that allows you to do that. So if you want to learn more about that, you can contact us as well. And we give that operating agreement to people that are investing with People's Capital Group. Okay, so that's the process of self-directing your IRA into real estate. Again, so we have questions as we go along here. Please put them in the Q&A. I always encourage questions. I see more people have jumped on. Always good to see. I'm going to touch on 3 different types of investors that invest with us, and then I'm going to wrap up here for the night and answer any questions we have as well. So the first type of investor we have that we like to work with are high-income investors. These are accredited investors. These are individuals that tend to have a lot of capital in the stock market and enjoy diversifying some of that into real estate, where they can get the same passive investment experience, but own brick and mortar real estate and enjoy those monthly updates and quarterly financials and cash flow checks. They're used to getting dividends generally from the stock investments. Cash flow checks can be comparable to that. However, we feel real estate is more predictable long-term, and that's what large investors like about real estate as well. It's a more predictable asset class. It doesn't go up and down with the volatility of the stock market as quickly. Generally in a recession, the stock market is the first thing to drop, then real estate may follow, but it really depends on the type of recession and what's going on. We do find well-managed apartment buildings in high-demand markets is one of the best ways to create cash flow through real estate. I see a question came in, keep them coming in. We'll answer them in just a few minutes here. And of course, the recession resilient, right? Markets go up, markets go down. You want to make sure your entire nest egg is not just in the stock market. You want to really get into something that's more recession resilient. And we do feel like well-managed apartment buildings are that. Active real estate investors like us, these are individuals that are maybe actively flipping houses or actively buying small income properties, but want to team up and get into a bigger investment. Also, they're looking to be less on call, less of a property manager, of a landlord, sit back, put their feet up, enjoy monthly updates, enjoy all the benefits of owning real estate and the financial benefits of it. The tax time is easy with our CPA firm that we work with, who do all of our tax prep and bookkeeping. So we make it very easy for them. And active real estate investors actually enjoy becoming passive real estate investors by investing through us just some of their capital as they exit a deal, and maybe they want to self-direct part of their IRA with us as well, or a solo 401k. So we enjoy working with active investors and helping them become passive. And then, of course, the IRA investors, the self-directed IRA investors, solo 401k investors. So a lot of people are invested in the stock market, either paying fees to brokers or just going up and down with the volatility of it. We do believe that real estate is a great way to hedge against inflation, hedge against recession, hedge against volatility of the stock market. So we also like improving our inner city communities, right? When you buy an index fund, you're not really making any difference in Newark, New Jersey or Patterson, New Jersey. But if you grew up around these cities and you live around them, or the building we're buying in Rahway, New Jersey, 2 blocks to the train station, people know these areas. They grew up around these areas. It's nice actually seeing your capital go to work in a mismanaged building in an inner city area and improving that building and improving that block, one property at a time. And that's really nice to see. And people really enjoy the tangible effects of investing your IRA into real estate, which you simply don't get by investing in an index fund. So it's just nice to see those tangible effects of investing in mismanaged buildings and making them a nice family-friendly place to live. That's one of my favorite parts of what I do, really is. Here's some quick client satisfaction. We've worked with over 50 investors. Again, 9 out of 10 of them reinvest with us over time. And here's Tim Carey, 5-time investor. I continue to grow my investing relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. Frank Bacuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. Chris Salerno, 6-time investor. I've been investing with People's Capital Group for nearly 5 years now. Could not be happier with the process, the returns on my investment. Aaron and Seth and the rest of the crew are fantastic to work with. They're like clockwork in their updates, communications, and payments. A great company. So I hope you enjoyed our presentation tonight. And if you do want to learn more or start that qualification process and learn more about that Rahway offering, we have the 27 unit that's 2 blocks to the train station. That'd be a great investment for an IRA. There are only a couple spots left in that. So you want to go to peoplescapitalgroup.com, click the button that says get started, fill out the qualification form, and we'll get in touch with you and see if you're qualified to invest here at People's Capital Group. We try to make it pretty easy to invest, so hopefully you are qualified. Hopefully you can go through that easy process of filling out the form and then sending the required paperwork in, and we can get you started on a solid investment in real estate in a high demand North Jersey market. And we work with IRAs, solar 401ks, and regular cash investments as well. And we've been doing this over 10 years. So go to peoplescapitalgroup.com to learn more. And now I'm going to answer some questions here and see if we can help break into any of the questions. Okay, so can you explain again what is the benefit of a self-directed IRA for the investment? Okay, so the benefit of a self-directed IRA is that you don't have to pay tax on the money you're earning. It's tax advantage or tax deferred income, right? So anytime you're earning income on an IRA is ideally tax advantage income, right? So if you're invested $100,000 in a property and over a 5-year period, you made $50,000 in profit, well, and you choose to exit the investment, normally, if you were invested through cash, you'd have to pay capital gains tax on that $50,000. That'd be about 25% of that. So right there, you'd be paying about $12,000 or so in taxes. With an IRA, you avoid that $12,000 tax burden. So that's one advantage. The other advantage of self-directing your IRA is you take control of your IRA. You now control it. You're putting it into an asset that you know that you're getting updates on, that you could even diversify part of it into something you're managing yourself. You can't pay yourself a management fee, but it's a way of really taking control of your retirement account, being a little more hands-on, not that you have to deal with the asset day in and day out, but just being able to take control of part of your retirement account. A lot of people like that part of it. So I think it's twofold, the benefit of self-directing your IRA in that sense. And you can also just invest cash in our real estate syndicate. About 2/3 of our investors are just high earners that are investing liquid cash. Generally, every 6 months, they're making an investment in a project. We tend to have a new project every 4 to 6 months. And investors like that because down the road, when that refinance is happening, about 4 years down the road, it's going to be a waterfall effect. Refinance, 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 right? If you're invested every 6 months in the project with us, that allows you to then really reap the benefits down the road of those investments as long as they're staggered properly. So invest with a self-directed IRA, invest with cash. It's all the same return on investment. It's all the same internalized rate of return. The only difference is if you choose to exit, a cash investment would be taxed, an IRA would be tax deferred. Okay, Kevin asks, what is the plan if the rules are changed with the bill pending in the House? Listen, I don't like it. I don't like it one bit. I think it's ridiculous for the government to. It does not in any way benefit the citizens of this country to not be able to self-direct your IRA. I think it's a huge amount of government overreach, and it just seems consistent with this administration that they're trying to limit a lot of the business activities that make America what it is. So it's really a shame. I don't think it's going to pass. First of all, it's extremely unpopular. If it really gets out, the media's not even talking about it right now. They need to talk about it more. I think it should become more mainstream, hopefully. Politicians want more votes. So if this is going to deter voters from voting for the current administration, then I would imagine they would not go ahead and pass it. But then again, I've seen crazier things happen in the last 8 months or 6 months. So, at this point, we want to just be ready for anything. And we want to call your local Congress people, let them know that being able to self-direct your IRA is extremely important. And there's a lot of companies also lobbying against this. So I'd imagine that it's not going to be prevented. And if the law does change, I'd imagine there'd be a lot of things done to push it back in the right direction, or a bunch of loopholes that allow you to invest in certain assets. I saw the law said, any syndicate, real estate syndicate you're invested in, you'd have to remove the investment in the next 2 years. That doesn't make any sense because most real estate syndicate investments are either indefinite or at least a 5-year period. So it's a completely unenforceable change of law that would be very complicated, open up the IRS and the government to tons of lawsuit, and they need that like they need a hole in their head. So for many reasons, I don't think it'll pass, but definitely let your current politicians know how you feel about that. And I'm doing the same myself. I think it's ridiculous. Huge amount of government overreach. Anyway, on that note, that looks like that's all our questions for tonight. So I'm Aaron Fragnito with People's Capital Group. And if real estate is not a part of your portfolio, then I really feel it should be. I've made real estate a large part of my portfolio, and it's been done wonders for me. It's allowed me to become a millionaire over the last few years with my partner, Seth Martinez, and help other people become wealthy as well and grow their wealth exponentially in a high demand market with well-managed real estate. So go to peoplescapitalgroup.com. Let's get connected. Let's get you qualified. Let's see if this is a fit for your investment goals. And if so, we can help you move to the next step to self-direct your IRA into real estate. Have a good night.